Hello, everyone, and welcome to our most recent installment of the Rosenfield webinar series for auto dealers. I'm Kathy, and I'm the organizer of today's webinar. I'm accompanied with our partner, Ken Rosenfield, and our moderator, Alicia Webb. We are super excited to have Casey Fernandez from Highland today. He is a risk expert and he's going to be talking about how to transform risk into opportunity. And so before we get started, I do want to remind everyone that we would like you to be part of today's discussion as well. We have the Q&A chat feature available. Please submit your questions at any point throughout the session. And with that, I will open the floor to our speakers.
Oh, can I say a couple of words?
Go for it.
Please.
Yes.
Oh, so hi, everyone. I'm also excited. Highland is a worldwide risk advisory and insurance brokerage, and I've learned a lot just chatting with Casey before this webinar started. And I already had a lot of questions for him because it's my nature. But I'm sure that y'all will have a lot of questions too. And so I'm hoping that everyone will ask their questions. I guess you have a little box you can write them into, although I can't see it. And oh, I see. Yeah. And so, yeah, I hope that we have a lot of questions from this, and I'm excited to hear Casey speak, but I think we're going to hear from Ken first.
I'm also real excited to have Casey join us. Casey's a real dear friend, and we share a lot of large mutual clients together. And I do have to say this to him is that he only has one fault. And the only fault that he has is he's a Red Sox fan, and I'm a diehard Yankees fan. After that, he's the most perfect guy on the planet. So,
Well, my wife and particularly my ex-wife might disagree with you, Ken, but all I say is, with respect to the Red Sox, add it to the list, and add it to the list. It's okay.
well, I'm really excited to have him here. As we want to start with the first slide, and this is, I think, very, very important topic that we have with our clients, especially after what's happened on both sides of the United States. Here in Florida, last year, we've had numerous hurricanes. It's shut down a lot of our clients over on the west coast of Florida. The whole state was impacted. And in California, recently with the fires they have and other issues, with earthquakes and things, it seems that both sides of the United States are severely impacted by items that are way beyond their control. And insurance, we've had instances in the past with hurricanes and tornadoes in Florida where insurance companies just bailed out of the state. And who knows what's going to happen in California after the devastating fires that they've had if insurance companies bail out of the state of California. What's that going to do to the automotive retail population? So to me, I think other tariff issues going on right now, this is an extremely pertinent and important subject for dealers. It's a huge investment. I call it more of investment than an expense and cost of what dealers realize in their financial statements. And we're going to talk about various alternatives, what's going to happen and what's available to dealers today. With the cost of suppliers, vendors, wages, to even repair or replace properties today is a lot more expensive than it has been in the past. It's just, if you insure with replacement value, what does that mean? And these are all definitions and things that we'll talk about later on that have a big impact on what your contracts are, what you're insured for. And are you covered today? Is the replacement cost or the repair cost going to be that the insurance will cover? Is that going to be sufficient to sustain what loss has been incurred? And we're seeing that today just from the hurricanes and the damage that was done on the west side of Florida. I think it's yet to be seen with the fires in California. What is insured and how much is it insured for, and what can dealers do to mitigate their losses, because it's expensive. We talked about severe weather, natural disasters. These are things way out of your control. Don't expect to see them. Hurricanes, you at least get some warning. Fires, you just never know what they're going to do. They have a mind of their own. Earthquakes happen whenever they feel like it. Out in the Midwest and the in the middle part of the United States, you have hurricane, you have tornadoes, you have hail damage and things like that. How do you mitigate for all that happens? So all these other items that happen naturally out of your control, you need to be prepared for these things. So when these events do occur, you're prepared. What's your action plan? There's also just recently we've had is like with the CDK issue. This is another kind of natural disaster that appeared to put dealers down last summer. When your DMS system goes out, it got hacked, and you weren't able to write repair orders. You weren't able to do buyer's orders for vehicles. You weren't able to order inventory. You weren't able to process repair orders for extended warranties or put the in-service data or get all these things corrected. Dealers lost sales to other dealers that were not on CDK because they were able to run their programs correctly and sell cars, issue service. That's also how was that covered in your insurance. Some dealers were, some weren't, some were. And additionally, you know, what did they have able to do for the provider? How were they insured? How did they get reimbursed? And all these things. So these are, I consider that as like a natural disaster in its own way as well. The volatility, whether the insurance company is adequate, able to pay the claims or insure the claims, and how well and how fast they react, what the pricing is, depending on recent developments, all these kind of things determine what the volatility is in the pricing for your insurance policies. Increased lawsuits and liability claims. This is also something like this we experienced with CDK. We worked on some claims with clients that were enormous, just enormous claims they filed against the CDK. And the lawsuits probably just start now, or some have already been instituted, or they've settled, given you rebates against future invoicing and things like that. You've seen all kinds of things, but those are all items that impact on what your claims history is, which impacts your pricing. The cybersecurity risk, we just kind of went over with the CDK issue, but that's rampant. And how well guarded you are for these. A lot of insurance companies may not pay for cybersecurity issues if you were prepared to follow all their rules of what you had to do to prevent things. So if you didn't do the correct actions they wanted you to do up front, you may not get your claim filed correctly. You might get reimbursed for your losses. So these are all things that need a lot of attention, again, being prepared. Politics, for example, I mean, these tariffs, how they're going to increase the price of cars. What's going to happen with that? Will you have lost sales? Who's going to be the winner and all this? These are all things that also the whole political climate's going to make an impact on what our rates are and what you pay and how fast things happen in the industry. So these are all issues that are here today, right in our face, that we need to deal with. Next slide. What are the biggest costs? What we're seeing in terms of where the main investments lay? Garage liability and the lot coverage is still big. There's still a lot of theft going on that we see. It's funny, I was having a conversation with a client yesterday about the EV charging stations and how they were getting dictated by the manufacturer in their dealerships to have a secure location now for people that want to charge their vehicles 24/7 based on where they're geographically located. And the first question out of their mouth was, how do we deal with this? How is it our responsibility to provide a secure location where they are for people to come in and out, and how do they do that? Do they have like a garage pass, or how do these people charge their vehicles at 2 a.m? And how many would even do that in the first place? But the coverage on that, what the insurance costs would be, when their company, they talked to the insurance company about it, was ridiculous. And they now fighting with the manufacturers. They don't want to deal with this. They're opting out. The workers' compensation is also a big item, especially for the technicians in the service department. That's are injuries, and when they do occur, they're usually large. Interruption insurance, we'll talk about that a little bit, but how do you compute the interruption insurance? We were talking about that a little bit before the seminar here, where in Florida, during hurricane season, most insurance companies want to look back over the last few months of what your business interruption losses could be. But those are like times during the year for sales. The big sales haven't come in yet. So at the winter times in Florida, service departments are really rocking and rolling. So does the contract state that the interruption insurance looks forward for your busiest time, or does it look backward to your slowest time? And that can make a huge impact on what your reimbursement is. The cyber liability we just discussed a little bit, umbrella and excess liability coverage. These are for other things that could be out there for sexual harassment claims or other kind of claims for workforce type claims or anything like that. And also defective vehicles. We're seeing if electrical vehicle catches on fire, something like that, is a dealer responsible? Can they get sued for that? We also are seeing a big advent, especially in the state of Florida and out west, for used pickup trucks and things like that, where they're lifting the cars and they're doing special stuff to make the cars basically not be covered by the warranties, manufacturer warranties. And what happens there? So there's a recent case where a jacked up truck got hit. It bounced around because it was so jacked up, like a bowling ball, and it killed a lot of people on a superhighway. The dealer is responsible for that because they jacked the truck up and avoided the warranty from the manufacturer. So these are all things that create some giant liabilities for something that just happened quickly and you don't have the chance to recover. So all these things, we're looking forward to Casey to get on, and I think this rest of this will be a very, very interesting, very insightful program. Thanks again.
Thanks, Ken. Kathy, if you don't have to switch any slides right now, I just want to make a couple quick opening statements. One, insurance is the most expensive way of transferring risk. Insurance companies have overheads of between 30 and 40%. So if an insurance company pays $1 for your claim, they're going to get back $1.40 eventually. So you're paying a premium, literally, with that. The other thing is, a friend of mine came up with this. I added one more at the end. A definition: insurance policies are legal contracts. They're written by attorneys. They're sold by marketing majors, and they're read and understood by pretty much nobody. Every once in a while, the general counsel, possibly a risk manager, will read the policies and so on. But we're in an industry that it's the most expensive way to transfer risk. The policies are convoluted and difficult to understand, and they're very expensive. And people get frustrated because, to Ken's point, they thought they had this, but they end up getting that, and no one's happy. So what we're talking about today is not necessarily like, hey, we can, give you this rate on, garage keepers liability or something like that. But we're talking more on your total cost of risk, because that's what we do as a company. We help clients reduce their total cost of risk, which includes premiums, but also includes claims, includes the mitigation of the risk, and also, any volatility. And Kathy and Alicia, if there are questions that pop up during this, you're welcome to interrupt me. This is not meant to be a monologue. I'm happy to entertain questions so that whoever is participating gets their questions answered today. So if you want to go to the first slide, Kathy.
Sure. I did want to actually share a comment we got from an audience member. They said, saw today that auto insurance rates may go up because of tariffs related to increased costs for vehicles and repair/replacement parts.
100%. I can absolutely see that being factored into to automobile costs, increasing. I mean, I know in Florida, I happen to be in Central Florida. I'm not sure about exactly the rest of the country, but in Florida, um, auto insurance rates have increased by double digits for the last 40 quarters. Think about that. So that's 10 years. For 10 years, we've had auto insurance rates increase by double digits every quarter. It's crazy. And unfortunately, with if it a car that costs $30,000, yesterday, and perhaps tomorrow is going to cost 35,000 or 40,000, obviously there's bigger exposure, and naturally rates are going to have to be increased to make up for that. Because if you have replacement costs, you're getting a brand new car because you had comp or collision on your coverage. Then if that cost increase, naturally the insurance cost is going to increase as well. So great point by whoever submitted that. If you want to go to the next slide, that'd be great. Okay. We're going to talk a little bit about a captive. A captive is a tool or one way to look at financing your risk, because that's all insurance is. It's a way of financing risk. And captive is simply a licensed and regulated form of self-insurance. There's really four ways to handle risk. You can avoid it, you can accept it, you can mitigate it, or you can transfer and insure it, with transfer it or insure it. So, a couple of quick examples. The gentleman that gave the comment earlier said about automobile prices going up. Let's take that. Avoiding, automobile increases. Well, how can you avoid automobile risk? Well, you can walk, you can bicycle, you can take a train, you can take a plane, you can take an Uber, or you can take a cab, whatever. Those are ways to avoid having an automobile. What are ways to accept the risk? That's a deductible. If you're willing to take a $1,000 or $5,000 deductible, if the insurance company is willing to do that, that's fine. And then mitigation. Let's say you have a teenage kid that's learning how to drive. Well, you want to make sure that that person goes to driver education school and gets that done. You want to make sure you practice in the open lot on a Sunday morning at 7 in the morning when no one's driving around, so that their stops and starts and everything go. You want to make sure they don't use their phone while they're driving. They wear their seatbelt, yada yada yada, and obviously that the car is maintained appropriately. Those are all ways to mitigate the potential risk with an auto. And the last one is insurance, because as we know, there's idiots out there, right? You might be a great driver, but there's idiots out there who will do stupid stuff. That's why you have insurance, because you want to transfer the risk for someone doing something stupid that ends up costing you money. So a captive is a way for you to control some of that. And it's not for everybody, but we'll go through some of the steps on it. And again, I'm open to any questions. Kathy, if you want to go to the next slide. Okay. So I love this, because captives are formed. Take the second one down, capacity. In California, people have insurance right now. Dealerships have insurance for their property, for their garage, open lot, all the inventory and so on. But what might happen in 2026 when insurance companies review that? They may pull out, or they may short their capacity. Maybe they're saying, hey, we're willing to write a $500 million worth of insurance, total insured value now, but maybe next year they'll say, oh, only 250 million. So they cut it in half. Well, what happens when supply goes down? Prices go up. So there may be a real issue for some dealers out in California to get capacity that they need to cover it. If you have a captive, again, it's simply an insurance company that's owned by the person that it insures. You have control over how much capacity you have to put out there. So control, like management of claims, capacity, cost. Typically captives are formed because you can beat the market in terms of how you control risk. And if you have a lower than average claims history, you can recoup 10, 20, 30, 40% of your insurance spend, rather than just giving that way to the insurance company. Coverage, you can
Casey,
create your own coverages, and there's a couple other reasons, but I think controlling capacity and cost, those three things on the left are key issues with a captive. Was there a question,
yeah,
Alicia
I had one
or Ken?
quick. Yeah, I had one quickly for you. So most of our car dealer clients are very familiar with captive insurance companies, but mostly they relate to extended warranty companies or maybe credit life companies or something like that. So I was wondering if just real quickly you could kind of explain, for a property casualty captive, what if there's any parameters they might have. I know it varies by state law in terms of how to get them started, what kind of seed capital they need, or something like that. Because it's in the extended warranty business, the seed capital is pretty low
Right.
comparative. But what's it going to be like for something like this, or if you have any kind of recommendations that you would have for starting a
Great,
captive.
great question. Extended warranty coverage is a phenomenal use of captives because the loss ratio is typically under 10%, which is incredibly low. So if you have, a bunch of people paying in $1 million of in premiums to that type of thing, and then you only have $100,000 in claims because of warranty, if your overhead is 20%, you're clearing 700 grand on that. So that's an example. For property and casualty, and I may have mentioned this earlier. If I've heard of the phrase in the captive world is, if you've seen one captive, you've seen one captive. They are your own creation. There are group captives. They are single cell captives. There are all different flavors and types of captives. But I'm going to talk generally about like a single cell, which is like a single family home. You own it. You take care of it. You put it on, as long as you're not in an HOA, you put on whatever roof you want on it. You paint it green, you paint it polka dot or whatever, versus a group captive, which is more like an apartment where you're renting a space within it. So the advantages and disadvantages to both. But let's say, Ken, for a single cell captive, I would say you probably ought to have at least $1 million in general liability, garage keepers liability, property liability, workers' comp, that type of expense. You ought to have $1 million or up to even consider doing a single cell captive, because just to actuarially do the analysis, do a feasibility study, and so on, you're probably looking at 80 to 100 grand just to get out the door. So, if you're a single dealership, or maybe you have a couple locations and maybe you're spending 200,000, a quarter million, it makes no sense to spend $100,000 to assess a captive that you may recoup money, because the repayment or the benefit might be 4, 5, 6 years down the road, and that's if you have a clean history. So for somebody that's maybe spending 400, 500,000 or in there, it's possible that a group captive might be an option, because with most group captives, the good news is the costs to entry are much lower than a single cell. You can typically get into a group captive by just submitting your information, saying, yes, I'm going to comply with the rules. If the group accepts you, it's like a country club. They have to vote you in, and you're voted in, then you just go forward. The disadvantage, obviously, is you don't control everything, and you're also sharing risk, as you are anyway with guaranteed costs, but you're sharing risk with other people within the group. But I would say, if you're spending $1 million and up, you really ought to look at a single cell captive, or just a captive offering in general, because you're probably leaving money on the table. Did that answer your question, Ken? All right. Do we have another slide, Kathy? Okay. Again, this is kind of redundant, but why consider a captive? Short and long-term savings. Again, the money with insurance companies. I know a lot of people are frustrated sometimes where there's a claim and the insurance company says, oh yeah, the guy cut his finger, and so we're reserving $100,000 on this claim. And you're like, Why are you telling me my loss history is $100,000? The guy cut his hand. He was back to work the next day. He had 3 stitches, and he's good to go. He's earning money. Well, the insurance companies are doing that to protect their balance sheet. Well, the same thing. If you have a captive, you the balance sheet, you get to set aside money into the captive, and if, knock on wood, if there's no claims or very few claims, the premiums that you pay just sit there in reserve. And after a period of time, maybe 18 months or 15 months, when the captive, the board looks at it and says, hey, we feel that all these claims have been paid out. It's been 8 months and, we don't see anything else popping up. Then you can use that money however you want. Also, you can obviously invest that money that's sitting there. It has to be very conservative. But the point is, the captive will reward you for being, if you're better than average. You have investment returns and so on. And the biggest thing is the insurance company is betting that on average, they have about a 60 to 65% loss history. And if your loss ratio is 20 to 30% over 5 years, you're going to be recouping, 30, 35%. If your spend is $1 million in 5 years, you're probably sitting on $1.5 million in reserves in the captive, again, to use however you want. I think the second thing where it says control is key for 2 reasons. One is we talked about capacity. If you're going to the market with guaranteed cost, you're subject to whatever whims they have of the market. So if there's little capacity and maybe you have a loan on a building and they say, hey, we want $10 million of coverage on the building, you might be paying out out the wazoo. That's a insurance term. You might be paying a lot of money for coverage that really you don't need. So that's key. But the other thing is on handling claims. All of us have gotten frustrated with situations where there's been a claim and we're like, the guy came in Monday morning and said he hurt his back, within half an hour. Well, everybody knows that he was at a weightlifting tournament all weekend, right? He was a weightlifting tournament and he had to leave the weightlifting tournament because he hurt his back at the weightlifting tournament. But he said he got hurt at work. So what do? Insurance companies invariably will be like, hey, we don't know from weightlifting tournament, this and that, pay the guy X and just be done with it. Well, with a captive, you control that. And you could say, no, I'm going to make a stand here. And even if it costs a little money with the attorneys, we're going to shut this down because we don't want habitual claims being filed because they think it can take advantage of us. So those are some reasons to consider a captive. Obviously, cost savings, flexibility, capacity, but also control. Kathy, next slide, please.
We had a crazy incident. This happened actually last weekend with one of our clients. They had a technician come into their service department on a Saturday when they were closed, actually Sunday when they were closed, work on his own vehicle. And I don't know what happened, but he ran his vehicle straight through the toolbox and it knocked the wall out of the service department and hurt him. Now they're trying to figure out who's at fault and how much insurance company is going to pay versus his personal vehicle insurance or something like that. It was just a crazy incident that just happened. They got it on the security cameras.
Wow, that is
total craziness.
Yeah, that is a crazy one. What I would say is that unless if he wasn't getting paid for that, and if he was just there on his own, that would not be a workers' comp claim. That should be just on his personal injury on his auto, on his no fault. But who knows, right? There are creative attorneys just like there's creative CPAs and creative insurance brokers, right, Ken?
I don't know any other people like that, but I'm sure there are.
Well, I'm sure you've picked up clients from some of them. Some of them.
Absolutely.
Again, with a captive, not everything is rainbows and flowers and so on. There's the possible downside to a captive. What are those? Well, first it talks about incurring unexpectedly large losses. That's why we say if we set up a captive and we have it actuarially correct, you have to invest 5 years. Why? Because in the first, we generally say you're going to have one good year, really good year, you're going to have one really bad year, and you might have three, typical years. So what happens if year one you have a horrible year, a couple catastrophic losses, and so on? Well, if you bail on the captive, you've just flushed a lot of money down the drain. And it's like if you make your assessment and you do your due diligence and you buy a stock and it's $10, and after in the first year it goes down to 5, and you say, screw it, I made a mistake, I'm going to sell. Well, you just lost half your money. But if you did your due diligence, if it was a smart purchase, you just caught it at the wrong time, and you wait, and 2 years later, that's trading at 20, you're like, okay, it was a good idea. So one of the things about a captive is you need to you need to have a strong balance sheet, and you need to be available or be prepared to write a check if you have a big claim. Compliance issues, there are great captive managers. Our company handles around 100 captives around the world. And believe it or not, Ken, over 60% of the captives that we handle are brought to us by brokers that are not Highland brokers. So I tip my cap to our captive team, because obviously a lot of people think they do a good job. Meeting and maintaining capital requirements, you have to have enough money set aside to let uh, the state who looks at your captive agree that it's sufficient to pay the claims. So you have capital issues, and you have volatility issues that you might have to write a check that you weren't expecting. But that's why we say five C's of running a captive. I'll name the first four initially. You have to have cash. You have to have a strong balance sheet. You have to. I think the next slide actually talks about this. Kathy, go ahead. You have to have great care, good loss history. You have to have courage, because you are going to, have claims, and it takes some guts to take a risk. And then you also have to have commitment. So said a different way here, financially stable, you're investing in yourself, good claims history, or if your claim history is just mediocre, it's not good, but you're saying, hey, we just hired for instance, we offer fractional risk management services. We just contracted with Highland to come in here twice a month to do X, Y, and Z. We're paying them and so on, because we want to get the claims history down from 60% down below 30. Then that's someone that might be a good candidate for a captive. Obviously, low loss ratio speaks for itself. I mentioned long-term commitment. What's long-term? We say 5 years or more. If it's shorter than 5 years, like, if we're talking to somebody and they're like, oh yeah, well, I'm done with this business, I'm going to exit in the next 2 to 3 years through private equity, I'm not going to recommend a captive, because what happens if in year one they have a horribly bad claim? Then it's going to make them less attractive to a buyer. Good risk management practices, proactivity, willing to work with other companies is simply if you're in a group captive. So obviously different if you're in a single cell. Group captive would be a different world. Alicia, Ken, any other questions?
Not at the moment.
Oh, Ken, do you have some more presentation? I mean, I always have questions, but
Yeah, we have another slide coming up.
okay.
If
You want me to ask a question while we're
Sure,
working on that?
yeah, go for
okay.
it. Yeah,
I
absolutely.
asked you this before we started, and one of our participants touched on it. Can you create an insurance policy to protect against tariffs?
Can you create an insurance? Yeah, the answer is yes. You can create an insurance policy to protect you against almost anything. The example that we talked about was Wimbledon, the tennis tournament. back in 2005. It was either 2004 or 5 when there was the SARS epidemic. They took a hit because they couldn't they weren't open for business. And Wimbledon does something like $300 million of business a year, and 99% of that is within 3 weeks during the tournament. So they actually purchased $1 million. It cost them $1 million in premium against a pandemic policy. So they paid that from 2006 until 2020 when COVID hit, and then they got about 170, something like 170 or 180 million check from Lloyd's of London. So you can create almost anything, but it's not cheap. Does that make sense? SARS and COVID were pandemics, so that was specific. Tariffs, there has to be an occurrence, and I don't know if you can actually create a policy with that. But obviously, there's 4 different types of risk. There's strategic, there's operational, there's financial, and there's hazard risk. So that would be in a strategic risk where you would probably have to figure out, how do we respond? How do we pivot? What do we do if we have tariffs of 25% on all our new cars? What do we do to create something where we can get around that and still serve our people?
I'll tell you some
Right.
crazy the loss occurrences we've had before. And this is going way back time, was against the risk of the manufacturer going out of business. We actually had some for Oldsmobile, Saturn, and I mean going way back in time, but they were able to insure against a disaster such as just the manufacturer going out for lost income. Those actually came to play. Now that was a long time ago, but could it happen today? Maybe.
Well,
You have a couple shaky manufacturers right now that have some issues going on. So there's the possibility of that as well.
Well, I'll tag team off what something you talked about a couple times earlier, and that is cybersecurity and cyber liability. Within the cyber policies, and the vast majority of them are what are called manuscript policies. In other words, they're very flexible. You can add or delete a lot of different things into them, but it's what's called contingent business interruption. So I'm a dealer. I'm rocking and rolling. Everything's going good, but over here, my company, what did you say, DNS? They have an issue, and all of a sudden, I can't operate my business. No one hacked me. No one did anything to my company, but I can't write purchase orders. I can't buy cars. I can't do all these things. I'm shut down. So you can put in a cyber security policy as well as your property policy what's called contingent business interruption that would protect you against somebody else falling down on the job, if you will, going out of business, having a breach on their end, but impacting you so that you are not knocked out because of it.
We may have had a technical difficulty over here.
Yeah, I was like, it's,
It's
I have a,
accident. My computer blew up.
yeah,
Okay.
I have a question about group insurance. How, if I'm going to join a group captive, how can I ensure that the other members of that group, that one of them might be very risky?
That's a great question, and that's a consideration of a group captive. Like I said earlier, a group captive is kind of like, getting in the club, joining a country club or something like that. They're going to want to see your financials. They're going to want to make sure you're acceptable and so on. I think what I would do, Alicia, is make sure you do your due diligence. What's the loss ratio of the group? What's been the biggest claim they've had so far? How is the captive doing financially, and so on, and ask all these questions so that you know what you're getting into, right? Because the last thing you want to do, and also the last thing you want to do is get into a group that doesn't have your standards or higher protecting you, because that's where getting to know the other people in the group are key, and making sure that there is a proactive effort to police, if you will, maybe not a great term, but to make sure that the other people are all complying with what's going on. Because you might have a guy that's, he's pretty good, he's on tough times, and he might all of a sudden hold back on paying money for mitigating claims, which might give rise to claims down the road, that type of thing. So what I would say is do your due diligence and make sure that you're working with someone who can guide you and advise you on whether this is a productive captive that would be helpful to you versus a problem down the road. Does that make sense?
It does. I unmuted myself. It does. I'm wondering, Kathy, Ken, are you guys still experiencing technical difficulties?
We're back thanks to Kathy's computer. I left
Yay.
mine to cover.
Of course, I can always keep asking questions, but we've got people on the webinar. Anybody else out there have questions? Do you want to go ahead and do your slides, Ken, and then we'll
okay.
We'll come back.
Well,
I'll come back in there.
As most of our clients know that have captives, that there are a lot of accounting and financial considerations. Some of the tax benefits are you create an expense. So you can charge fees and things out of the insurance company to charge the dealership and the other related entities. So that's one way of moving income from the dealership, getting an expense, and depending on the type of captive you have, whether it's offshore or domestic type environment, you'll get some tax benefits for it. And the way the captive insurance companies are taxed, most of the time it's on their investment income. So you can defer and move a lot of income. You can also help with your estate planning, having your successors or other family members that may not want to be in the dealership business, but it's one way of moving some of your estate and liquidity in your estate to another entity, to other members of your family and friends or that kind of thing. So there are some really good tax benefits for having a captive insurance company. Now there is an downside. There's an upfront cost. You have to capitalize the company. And that's someone you need, Casey, to help you get involved with something like that, of what the seed capital needs to be. It's going to vary by state on what the capitalization requirements are. And so there is an investment, but it's investing in yourself as well. So if you know your company well and you know your environment well and what you think the long-term financial stability is going to be of the insurance company, what you think it's going to be, then it could be a great investment for you as well, just as the extended warranty companies have been for most of our clients. It's going to have some kind of financial statement impact with if you have the expenses coming out, it's going to show some decreased profitability in the dealership. But at the same time, if you're doing self-insurance or something like that, you're going to be moving liquidity to another section of your balance sheet to help pay for future losses. And if you're getting a CPA prepared financial statement, you're going to need to put some kind of reserve for future losses and that kind of thing. So that would kind of impact you'll have on your financial statements. Also, not just the IRS, but all the states have their own specific requirements for insurance companies. Each state's different. So you'd have to comply with the state you're domiciled in, or if you're offshore, there's other issues you have to deal with that to make sure it's proper insurance. We've all gone through all those fun times with the IRS on the offshore companies. I think that's pretty well under control now. So following pretty much the same footsteps as you would for an offshore extended warranty company, you'd have for a property casualty company as well.
Ken, if I could tag on to that, your comments,
please.
It's super key in anything. Remember when you were growing up, your parents always wanted to know who you're going to be with, what are their parents like? They'd ask you all those questions. Well, it's no different with this. You work with an organization like Ken's company to handle your tax ramifications with respect to a captive, with a good legal group that can help you as well. Because there's been a lot of people that have spouted off the tax benefits of a captive and end up skewering their clients and having them in really bad shape. There are tax advantages to a captive. However, that's not the reason to get into a captive. The reason to get into a captive is you're looking to transfer risk in a smarter, better way for your organization, and you get to reap the benefits, some of which include tax benefits. So great point, Ken. But obviously, if somebody is listening to this, they probably already have a relationship with you or are interested in a relationship with you. And Ken's an expert when it comes to automobile dealers and quality person in terms of long term, and that's who you want to deal with on anything like this.
Thank you. Some other items we talked briefly about earlier about how you compute business interruption insurance and things. Really take a good solid look at your seasonality, and if you're in certain areas like Florida, for example, hurricane season, you want to really make sure that your definitions of business interruption compensation from the company works towards your benefit. So the time if you have a hurricane in September, you're not going to be back in action to maybe later on the first quarter of the following year. So you're going to be gone a long time, not having business going forward. And that's your busiest time of year. That's typically our clients in Florida, their service departments have a huge increase in revenues versus the summertime, because the winter times when all people are in the state of Florida and there's more service work. So look specifically at the language of these and go through all these line items. Don't just sign your policy blind. Make sure that you're covering the things you need to cover. Look at the cost of what you're covering and what it's going to take to get that facility rebuilt. I mean, I remember hurricanes back, this is a long time ago, but what the costs were of the devastation that hurricanes can do. We had a client. This is back in the days of the Plymouth Prowler. It was a Prowler. They had one. They stuck it behind a garage door. Well, not just a hurricane came, but a tornado came at 200 miles an hour, ripped this garage door off. The garage door does a back 2.5, like it's doing a diving competition, lands on this Prowler, bangs it like up and down like 20 times. This is all caught on camera before it ripped off the wall and destroyed the Prowler. But then the Prowler went into pieces and it flew into other vehicles that are sitting in the service department and just did so much damage inside. It was unbelievable. And the our client at the time was not covered because of the way they moved their cars around there. They just said because they placed the cars in a precarious environment. I think that was the word they used. In anticipation of all this, they weren't covered for all this stuff, and it cost them hundreds of thousands of dollars to replace and fix and repair all these vehicles that are in they moved into their service department. The way their contract was written, it would have been better to keep them outside and just go through the normal lot. Why all this, I don't know. But these are things, just little nuances in your contracts of what you need to review and make sure that you're specifically and adequately covered. We also found instances that sometimes an insurance company may use a more generic form that may not work in your state. So those are things, to look at as well. So you really need someone qualified to look at your documents really well. So the moral story, read the documents, or have somebody knowledgeable read the documents and make sure it's adequate for what you think your needs are going to be. We discussed a little bit more about replacement value versus cost of fair market value. There is a difference. There's a legal difference between those terms. I'm not a lawyer again either, but know what's going to be best for you. Is it replacement of what it takes to actually put it back into service the way it was? Just fix your costs and just reimburse you for what you put into it. That may not be enough to add it to the cost of what the replacement value is, or what the fair market value of that property is, with everything that's included, what your leaseholds and actual concrete and hard bricks and everything else. What's going to be the most desirable and best for you to maintain? So those are all three different items that need to be explored to make sure that you're compensated what you need to have to go back into business, because you don't want to just get a check from the insurance company and it's not adequate to put you back in business where you were. Deductible methodology, I'd probably have to let this to an expert like Casey, but we have a lot of our clients sometimes call us as, what if we have our deductible at a higher amount, we get a lower premium and all these kind of things. And it all depends on your loss ratios and all these things. Those are what you need experts like Casey to help you with, is determine what's that best mix between deductibles and amount of insurance and costs and premiums and all that, and then explore that with, should you do it yourself? If you can have a high deductible, then maybe you should have your own insurance company to do that as well. And like the coverage issue, who's at fault? Like this crazy thing that happened a couple of weeks ago in the service department with our client. I mean, I got a call from our client Sunday afternoon.
Hey, Alicia, Ken, stop for a second.
Yeah, sure.
Sorry, Ken, you just stopped for a second on the feed.
Oh, I'm sorry.
No, the feed went south, but you're good.
Oh, okay. So I mean, just when I got that crazy call a couple Sundays ago, with our client said his mechanic came in and drove the car through the wall of the service department. He was like, well, who's going to be responsible for all this? But he needed his service department fixed right away so he can be back in business, because where he's located, they weren't going to let him be back in business right away. Oh, plus it took some power out at the same time. It just hit wherever the junction box was, and took the whole power out of the service department. So you just never know, what's going to happen, but you need to be prepared of what's going to impact your dealership. So,
and dovetailing off two of the things you said when you talk about deductible methodology versus self-insurance, I mentioned earlier, you can transfer, you can accept, you can avoid, or you can mitigate risk. And really what the key there is, we actually will do what's called risk optimization. And that's a fancy word for saying, how do we piece and parcel that puzzle? How much risk can you take? How much can we avoid? What do we want to transfer? And so on. And putting that together, it'll be different for every business, but that's the key. That's really what we're trying to do when we're reducing the total cost of risk. Yes, sometimes it's buying less insurance. Sometimes it's buying more insurance, but maybe higher deductible, so that you're protected on the backside for higher limits, but you're willing to eat the first 10 or 25,000. The last thing on coverage issues, you make a great point. All I would add, and it's sad, but this is the world we live in, is you call your buddy, he's on the golf course, you say, hey, am I covered for XYZ? Oh yeah, you're covered, no problem. Hey, shut up, I got a putt now. Hangs up the phone. Get it in writing. Get it in writing. Get it in writing. If I'm very, very obnoxious, my wife will confirm, when it comes to specificity and making sure that the client, the underwriter, everybody, we're all under agreement on what is and what is not covered and how it's handled. And you want to have those conversations prior to a claim, not after. Sorry, Ken.
oh, that was perfect.
So I have a question. Because I live in California and in LA, and so we just went through the fires, which fortunately didn't impact me, and we discussed this before. Given that we don't really have a fire season anymore, we just have fires. How does that impact our ability to create a captive to cover my dealership? And also, I was just thinking, if I have a large dealership group, and I have some dealers in California, but others in states that are not quite as risky as California, how do I handle that?
Well, the great question. I think anytime you have a diversity of risk, and maybe you have 5 dealerships in Southern California, a few dealerships in Arizona, some in Utah, New Mexico, that is phenomenal, because it allows anybody to spread the risk, and lessens the likelihood that one claim or one incident or one occurrence can wipe everything out, right? It's the difference between having multiple apartment complexes, let's say, all over the state of Florida, versus one 50-story condo that the whole kit and caboodle is there. So I would say you're going to get higher rates for the Southern California between, assuming you include earthquake, wildfires, and so on, as opposed to maybe Utah or Arizona or New Mexico. But that blend can help lower the overall risk. And you internally can decide how much we're allocating to the Southern California dealerships versus the Arizona or Utah dealerships, and how that works.
So it's quite customizable, it sounds like.
Absolutely. Absolutely. Especially if you're big enough to have a single parent captive, you're the one running the show. And I don't know if I think I have alluded to it. All of this depends on what are your goals as an organization. You know, if your goal is one thing, then maybe a captive isn't appropriate for you. If you say, hey, I'm going to be around for 15 to 20 years, to Ken's point earlier, I want to set aside some a legacy and have some money aside for, you know, this cause that I'm passionate about and so on. And the dealership is doing well, but maybe isn't driving enough of that. Well, if you're big enough that you're spending $1 million, $1.5 million, $2 million, a well set up captive should spin off 25 to 35% of your spend, a well set up captive over time. So if you're spending let's just call it $1 million for math, and let's go on the low side, 250,000 a year. In 10 years, you should have $2.5 million sitting aside over here. And if that helps you with your goals, then it's a success. The whole idea is a captive, to Ken's slide here. It can be a strategic financial tool, but it's not just about lowering costs. It's all predicated on what you're trying to accomplish as an organization and as a person that owns it, and getting you there in a maybe a faster, better, smarter way.
Cool.
Ken, I can't hear you. I don't know if you can hear him, Alicia. My apologies, Ken, I
Yeah,
can't hear
Ken.
you.
Yeah, Ken, Kathy, we can't hear you.
Oh, we can hear you now.
Okay.
There you're
So
back.
look what happened in the Carolinas where they had a hurricane impact them. I mean, really big, really devastated the Carolinas. They may not have been insured for that, for flooding and windstorm and things like that. You know, so now that they've experienced what a hurricane's like coming through their back door, you know, what are things that you think they should look at for the unexpected? Because I mean, I don't think they ever expected to have the issues that they had, and I don't think their insurance policies carry that.
Well, great question. I think they should have a conversation with their broker, or a broker, or me, if they want to talk to us about, you know, what's going on with exposures. You know, you mentioned flood, you mentioned windstorm, and so on, obviously fire, and see what's the likelihood that they're going to experience this again. Because the bottom line is you've got risk. How are you going to deal with it? Like I'd mentioned earlier about risk optimization. What's the likelihood of this happening again? What's the downside if you have to write a check out of your pocket? And how do you want to deal with it? Do you want to transfer it? Do you want to accept it? Do you want to try and mitigate it? And those are conversations that we have every day with clients. And we'd be happy to talk to them. If you have a great relationship with your broker and your broker's on top of things, hopefully you haven't experienced a bad situation. But if you have a great relationship, go to your broker and have these conversations and ask them. If your broker is not attending to your needs, we're happy to have those conversations with you and see if we can help.
So, right on time. I think perfect.
Yes, thank you, everyone. Lisa, did you have any other questions, or should we just wrap it up? We are close to the 1 hour
Nope.
mark.
I think I'm good. Anybody else out there have questions?
We had a shy audience today. That's okay. Maybe we answered all their questions.
Alicia, Kathy, Ken, pleasure. Thank you very much.
Thank you. Thank you both.
Thanks,
Thank you so
Casey.
much.
All right.
We hope
Be
to
well.
catch you all at the next webinar. Thank you, everyone.
Thanks, y'all. Bye.
Bye-bye.